Hey yo, what's up everybody? Good day to you all, ladies and gents. Welcome back to Matrix Investing, the #1 YouTube channel that is dedicated towards giving you education based on investing in capital markets. Now in this video, we're going to look at the statement of cash flow as well as its components. Now if this is the very first time you're watching our videos, we advise you to check out our previous videos so that you can have a better understanding of what exactly we're teaching. If you also find this video, by all means, please like this video, subscribe to our channel, and click that notification bell so that YouTube gets to notify you each time we get to upload videos into the platform. Now with that said, ladies and gents, let's get down to business. Starting off by understanding what the statement of cash flow is. Now, this is a financial statement that shows cash and cash equivalents that are circulated in a business. Or this is a statement that shows how cash and its equivalents enters and leaves the hands of the business in a specific period of time. So by all simple means, the statement of cash flow is simply a financial statement that shows how money flows or how money circulates, or basically all the transactions that are cash involved in the business, how the money came in the first place, how was the money used, and how did the money go. So then that is what the statement of cash flow teaches us. That is what the statement of cash flow shows us. So then it talks about cash as well as cash equivalents. Now, cash equivalents are basically short-term investments that are invested by a business with the intention of getting short-term profits. So then this could mean investing into shares so that a business can get short-term capital gains, or this could mean maybe a business invested into shares simply because they have dividend payments due very soon, so then they're just in there for the money and leaving. This could mean investing in bonds for a short period of time, depositing your money in a bank account so that it can pay you a hefty savings. It can pay you a hefty interest payments on your bank account. So then all these are considered as cash equivalents, basically short-term investments. Now, this is, however, in a specific period of time, depending on how the business, or after how much period of time the business has decided to prepare that statement of cash flow. So then this statement is used to measure how well a business is able to manage its cash, and as in how good that business is at making money, paying down debts, and financing all its expenses. So then by looking at the statement of cash flow, an investor is expected to learn or to understand how well the business is good at getting income, first of all, getting its income, paying down its expenses in a controlled manner, as well as paying down its debts. So then the importance of these statements to investors is that it allows them to understand how a business is run, where does the money come from, how is this money used, therefore helping an investor identify if the business has got a proper financial foundation. So then by looking at the statement of cash flow, an investor should understand where the money comes from, how the money is used, how the money leaves the business, and from there an investor should be able to make a decision as to whether a business is fully able or pretty much knows what it's doing with its cash, or if it's just blowing up money. So then let's get down to checking out the components of the statement of cash flow. So then the first component is cash from or used in operating activities. Now this aspect shows the sources as well as the uses of cash resulting from operating the business activities. It shows how much money has been made from goods or services that were prepared by the business with the intention of making money, that is through selling, as well as changes in the working capital. Now, in summary, the whole reason as to why a business exists is to provide goods or services that are there to help people out in certain ways. Now, in exchange of providing these goods and services to customers, there is cash that a business receives from selling such goods or services. So then that cash that is received is cash input. That is cash in. That is cash that has entered the business as a result of its operating activities. However, there are also other expenses that are related, that have a relation with the operating activities. There are other expenses that are quite involved with the whole process of the business's main operations. So then all these other expenses is cash output. So then this is cash that is leaving the hands of the business. So then these cash that is leaving the hands of the business is cash that is used in operating activities, the cash that has been spent by the business in the whole process of its operations. So then that is also recorded in this aspect. Now, leaving aside how cash enters and leaves a business as a result of either being directly involved or indirectly involved with the whole core purpose of the business, the other aspect is changes in working capital. Now, working capital is basically the difference between the current assets and the current liabilities. Now, if you refer to the previous video where we talked about the statement of financial position, we showed you an accounting equation that states assets always equals to capital plus liabilities. As we were going through the actual statement of financial position, we were able to prove that assets equals to capital plus liabilities. So then we're just going to do a little bit of math here. So then when you take the liabilities and put it on the other side of the equation, putting it on the side of the equation with the assets, so then that plus liabilities becomes minus liabilities. So then assets minus liabilities is equal to capital. So then in this case, as we're trying to look at the current assets and current liabilities, the difference between the current assets and the current liabilities is known as working capital. So then any change, any increase or decrease in the working capital shall be recorded in this particular aspect, cash from or used in operating activities. So then an example of such activities is revenue earned from selling goods or services to customers. So then that amount of money a business gets from selling goods or services is recorded here. There is interest income on expenses. So then we all know that a business, when it loans out money from the bank, it has to pay that principal amount with interest. Now remember, the whole reason as to why the business had loaned that amount of money is so that it can enhance its existing operations or enhance its core operation. It's usually more likely that way. So then when you have to pay out interest payments, although the interest payments have got nothing to do with the direct production of goods or services or the day-to-day operation of the business, however, that expense is there in the first place because of operating the business. You borrowed money from the bank so that you can operate the business in a better way. So then such interest expenses are put in this aspect. Then there's interest income, which is a result of the business having a certain amount of cash in the bank, and then the bank has to pay out some amount of money as interest. So then remember, you put that money in the bank for what reason? That money is there in the bank for a most obvious reason. The most leading reason as to why that has happened is so that you can have a place to go in case you need cash to enhance your operating activities, so that you can, in case you need cash to deal with the business's day-to-day activities. So then that's why interest income is there. And then there is payments of income tax. So then income tax is basically tax that you have to pay to the government as a result of your operations. So then if a business exists, it obviously has to pay tax. When a business is operating, it obviously has to pay tax. So then that expense is also recorded here. So then looking at the second component, which is cash from or used in investing activities. Now this aspect shows sources and uses of cash, which is a result of investing activities of a company. So then such investments could be within the business itself or investing in other businesses, as well as payments from such investments such as dividends and interest. So then basically a business could have two options as far as this component is concerned. The business could either choose to invest upon itself, or the business could choose to invest upon other businesses. So whatever cash that has been received, or whatsoever cash that has been spent from either one of these two decisions is placed into this particular aspect. So then examples of such activities are buying or selling of a business's assets. Now this, ladies and gentlemen, is an example of a business trying to invest in itself. A business buys an asset for the sake of enhancing its operational activities, for the sake of improving production or efficiency, using the latest technology, using the latest assets, the one that is shown to have the best operational efficiencies and etc. So then that's why a business would want to buy such an asset. So then by doing so, a business is investing in itself with the sake of getting to improve itself over time. Now, a business would also likewise sell its assets, maybe because the assets are a bit worn out, the asset might be out of date, the asset might not have a great efficiency in production, so then forcing the business to sell that particular asset. So then that asset is sold. That is also an act of a business investing in itself. The business wants itself to have the best assets deployed towards making the best out of every resource it has. So then every resource it has should be at its peak quality. Another example is buying or merging with an existing business. So then when a business decides to buy out another business, be it having the same or different operations from the existing one, so then that whole process of buying a business is also put into this aspect. So then that is a business investing in another business. Or when businesses decide to merge. By merging, we mean businesses decide to unite or fuse to form one business entity. So then the expenses or income, that's a huge if, so then the expenses that have been involved in the whole process of merging into one business entity falls under this aspect. And then the third example is buying shares or bonds into other organizations. So then when a business decides to buy shares or bonds into organizations such as businesses and governments, that is an act of a business investing into other organizations, and that is obviously put in here, as well as income it might get, such as dividend payments, as well as interest from bonds. Now you have to differentiate the interest income from that one as a result of operating activities, and this one as a result of investing activities. The one that is from operating activities is more likely have to deal with bank accounts. Like, I have a bank account, I saved up money in there, and oh my god, look, I just got some interest income from my savings. So then that is obviously in the operating aspect. But the investing aspect is more like, hey, I bought bonds and those bonds paid me some interest at a certain coupon. So then that interest from bonds is more likely put in the investing activity side of the cash flow. Now, checking out the third component, cash from or used in financing activities. This aspect shows the sources of cash that were used in financing the business. The cash that flows into the business represents capital being financed, and money leaving the business might represent payments of loans or payments to investors. So then basically cash from or used in financing activities pretty much shows us how the business has attained its finances as cash in, and cash output being how a business is to provide either returns to investors who have provided the finance, or paying back of such finances in case the business had attained these sort of finances for a specific period of time. Okay, so then looking at the examples of such activities as a result of financing activities is payments of dividends. So then if a business had received cash from the issuing of shares, that is cash in. Cash output would probably be to pay out these investors dividends. Second activity is payment of interest. Now, in case the business had issued bonds, cash in is money that has been money as a result of selling bonds to investors. Cash output would be to pay out interest payments. And then there is payments of loans. Now, payments of loans is also, remember, when a business acquires a loan from a bank, that amount of money it has acquired from a bank is still termed as finances. That is a business trying to finance. That is a business trying to attain finances. So then cash in would be payments of loan. But however, cash output would probably be repaying of such loans. So then when a business decides to pay back this sort of loan, remember that this finance it had gotten from the bank isn't permanent. It has to pay back this amount of finance. So then cash output is repayment of such loan. And remember, the interest payments is put on the other side of the operating activities for reasons of which we have shown and discussed a bit earlier. And lastly, I feel like you should know this, is when a business decides to buy back its own stock or buy back its own shares. So then we all know that when a business goes public, it issues shares to the public. Everyone gets to own that business. Everyone is happy. Yay! But then, however, for the business itself, the business might be like, I think we've dropped too much shares and we're having less ownership with our own business. So then a quick suggestion might be, a quick move for us is to buy back shares from these investors. So then when a business starts buying or purchasing its own shares into its own business, so then that particular move, the cash that is flowing for the cash that is flowing out of the business, so that to acquire more ownership into that exact business, also falls into this aspect of the cash that is from or used in financing activities. The last component is cash and cash equivalents. Now, this aspect shows the amount of cash and its equivalents at the beginning of that specific time, the time of which that cash flow statement was drawn. The value of the cash and cash equivalents, the change in value of cash and cash equivalents, and the value of such items at the end of that specific time. So then we'll understand that this entire process of the cash flow, like we mentioned earlier, it's all about money moving in and moving out of the business, money entering and leaving the business. So then this last aspect of the statement of cash flow shows the amount of money, the amount of cash that was there at the start of this specific period, the change in value of these cash and cash equivalents, that is when the money was moving around the business during that specific time. Was there an increase in value? Was there an increase in the cash and cash equivalents? Or was there a decrease in cash and cash equivalents? So then that increase or decrease is put there, and if it's an increase, you add it with the cash at the beginning of the year to get you add it with the cash and cash equivalents at the beginning of the year to get the cash and cash equivalents at the end of the year. However, if it's a decrease, then you add the cash and cash equivalents. You take the cash and cash equivalents at the beginning of the year, subtract it with the cash and cash equivalents, the change, the decrease, and therefore you get the cash and cash equivalents at the end of the year. So then that is everything that has everything to do with cash and cash equivalents. Gosh. Okay, so then with all these components discussed, with all these components shown, let us see what an actual cash flow statement looks like. So then let's get down to it. Alright, ladies and gents, here's an example of a statement of cash flows by the company Vodacom Tanzania. This is for the year ended 31st March 2020. So then this statement of cash flows covers the year's worth from the 1st of April 2019 up to the 31st of March 2020. Now, looking at the statement of cash flows, there is the 2020 aspect and the 2019 aspect. Now, I think I've said this, that they usually show 2 years worth. They usually show 2 years worth of data for the sake of comparison. And then there's the TZ shillings millions, which means that all these figures here actually have 6 zeros after them. So then for the sake of simplicity, as far as representing these financial statements are concerned, we just omit those 6 zeros and write TZSM, meaning that these are in million T shillings. So then, looking at the components themselves, there's the cash flow from operating activities. Now this one has tried to show a summary of all the operating activities put right there. They've just deducted the income tax paid, and then they show the net cash flow from operating activities. So then there's net cash flows used in investing activities. We can see the investing activities used right there, which reminds me, by the way, as we were reading through the components, we were always like cash flow from or used in. So then when there is an amount of money that has still remained from a particular activity, then that is net cash flows, or that is cash flows from something. It could be cash flows from operating activities, cash flow from investing activities. You mention it. But then however, when there is no cash that has remained, that is when a business has spent and the figures are in negatives or put in brackets, then that shows the amount of cash that was used in investing activities. So then we can all see there is net cash flow used in investing activities, which just shows that there was no cash that remained. All the cash was spent till the negative balance. Then there is the cash flows used in financing activities right there. And then we finally have the cash and cash equivalents, we can see the opening balance. No, they first showed the increase in cash equivalents, added it to the opening balance as of 1st April, the previous year, and the effects of exchange rates from cash and cash equivalents held in foreign currencies. So then perhaps Vodacom has got some cash and some short-term investments in foreign currency. So then if there was an increase in value that has resulted from that foreign currency, then that increase in value traced back into Tanzanian shillings is placed right there, and we can finally have this cash and cash equivalents as at 31st March 2020. Now, which also reminds me another important note or another important fact. The cash and cash equivalents that is usually showed at the bottom line of the statement of cash flow is usually equivalent to the cash and cash equivalent that is shown in the statement of financial position under the current assets. So then we just have to remember this number here. 473,828,000,000 is the cash and cash equivalent that has settled down as of 31st March 2020 after that entire process, or after that entire movement in money. So then if we go back to the statement of financial position, nope, this is not it. If we go back to the statement of financial position, right at the current assets right here, the last figure, the last entry, cash and cash equivalent, we still see the same 473,828,000,000. So then the cash and cash equivalent that was recorded at the end of that financial year is put back to the statement of financial positions, and that figure remains the same. So then, ladies and gents, I believe this is all we have to cover for the statement of cash flows. Unfortunately, this company has not prepared notes to it, but in most likely cases, or in most normal cases, you'll probably find notes towards these transactions, or towards how the money has been moving around. So then you could always refer to the notes so that you can have a better understanding, or a more explained way of how these transactions, or how this cash had been flowing around the business. So then, with that said, ladies and gents, thank you so much for watching this video. If this video was helpful to you, please help us out by liking this video, subscribing to our channel if you haven't, and hitting that notification bell so that YouTube gets to notify you each time we get to upload content into this platform, so that you do not miss out on any sort of video whatsoever we get to post. If you're on other social media platforms such as Instagram, Facebook, and Twitter, you can check us out there through our account, Matrix Investing. We upload content on a day-to-day basis, so then every day you wake up, or every single day you find, or you will get some sort of knowledge that is related to investing in capital markets, specifically in contextity to the one of Tanzania. So then, thank you very much, ladies and gents. Please don't forget to subscribe.